Again, a very good morning to you all. Early morning in India, but again, we have participants joining in from very different geographies. For those in US, a very good evening and good afternoon for those who have joined in from the eastern part of the Asia. So it is often said that money cannot buy happiness, but with some planning and discipline, we all can certainly build our wealth to meet our long-term goals. In the backdrop of an uncertain economic recovery, the Singapore chapter thought it would be a good idea to get some guidance from experts on financial planning and building portfolios for a volatile uh, stock market, with some focus on the Indian market. Given the breadth of the topic that we intend to cover today, we are very fortunate to have two very accomplished professionals from the industry who can speak credibly on the subject. I would like to first welcome Mr. Arun Kumar. Arun is the head of research at Funds India with more than a decade of experience in the Indian wealth management industry. Prior to joining fundsindia.com, Arun was associated with wealth advisors for close to 8 years, where he was a fund manager for various asset allocation based PMS products. During his time there, he had also built their robo advisory investment platform from ground up. After that, he was with IAFL Wealth, India's largest wealth management firm, for a year. Arun has a very wide experience across behavioral finance, fund management, asset allocation strategies, product development, portfolio construction, and fund research. He has also been a widely followed personal finance blogger since 2016 on 8020investor.com, with more than 5 lakh plus views till date. He has completed his bachelor's in electrical and electronics engineering from Sri Venkateshwara College of Engineering and has an MBA specializing in finance from Bharatidasan Institute of Management, Trichy. Arun, a very warm welcome to you on behalf of Loyola Alumni Singapore chapter. Thanks for taking time to be with us today.
Thank you so much for inviting me and looking forward to having a great conversation. Thank you so much.
Next up, we have Carl Rodriguez um, from our own Loyola fraternity. Carl is an accomplished banker with over 15 years of experience working with some marquee names in finance and wealth management across different geographies that include India, UK, and Singapore. His career spans roles in research, structuring, and advisory. Some of his key assignments include heading India access products for Society General, in particular structured fixed income and FDIs for its global private clientele. During his time there, he was responsible for structuring the first cross-border distressed debt fund out of India. He is now a senior private banker with a renowned Swiss private bank in Singapore in a relationship management capacity. Carl is an alumni of LIBA from the 2003 to 2005 batch. Carl, thanks for joining us today.
Thank you for having us here.
So before we jump into the topic, a quick legal disclaimer, given that the topic that we are going to talk has a lot to do with finance, personal finance, and investments. So any expression of opinion is personal to the guest speakers, and the investment choices that would be discussed today are provided as general information and are not made with regard to specific investment objectives, financial situation, or the particular needs of any particular participant. As such, the guest speakers may not be able to advise on specific securities, products, or stock tips. We are, however, very keen to hear your questions and views as we go through the session. So kindly request you to post your questions in the group chat. So we will take them up once we cover the topics. So it is said that the wealth cycle typically has three phases. The first is wealth accumulation, the second, wealth preservation, and finally, wealth distribution. In each of these phases, our risk profile is very different, and so is the process by which we make decisions about money and investments. If you look at the first phase, for most of us, a significant part of our work life is spent in the wealth accumulation phase. This is when we start saving from our regular income to build the investment capital that would generate future returns. This is also the time when some of the young professionals are taking their first steps towards investing in asset classes such as bonds and stocks. Some of them take up ULIPs or insurance-linked exposure to the markets, and off late in the last few years, it's more of a systematic investment plan. Some are dabbling with investing in directly investing in stocks, more of an active involvement. So what would you suggest for a global Indian who would like to build a portfolio with exposure to equity markets? Should the person invest in US markets or Indian markets or in the country that they are currently working in? How should one approach this, and what are the implications? Carl, would you like to go first?
Sure. Thank you. I think the question is very nuanced and very deep. And a lot of it, I would suspect, depends on the individual at hand. Right? Even before we attempt to walk through and identify, should we be putting money into the US? Should we be putting money into Asia? Should we be putting money in Europe? One should actually look at your own personal P&L. Right? Everyone needs to draw their own personal P&L, identify what are their long-term objectives, what is their current state and status right now, and how do you want to present oneself? If your long-term objectives are going to be driven predominantly related to India and focused towards India, the answer resides there. Look at India. India is a phenomenal story. It grows at, even while we are sleeping, it grows at 8%. Good governance or bad governance, the country is going to boom. There's no doubt about it. So if you just put money into any form of business, your own business, if you have a small tailoring shop, or if you have a small hairdressing salon, or if you have a consultancy business, that is going to grow at the very least at the normal GDP growth rate of the country. There's no denying that the opportunities in India are huge. If you, I'll just give an example of what we're saying, right? Despite any form of pandemic, despite any form of disasters, be the global financial crisis, be it the dot-com bust, if you see how the index in India has evolved, it's just given us it's given us multiples, 4 times, 5 times, 6 times, despite all those disasters that pretty much everybody has written off. So India grows while we sleep, pretty much. The US, on the other hand, is the world's largest, deepest, and most liquid market. Right? Accessing that has its own benefits. Right? They are leaders in terms of technology, the way the economy is built itself. The drivers of that economy are far different. So if you are an overseas investor with surplus liquidity, I would think the US needs to be a big part of your portfolio. India can form a significant part of the portfolio. If you don't have assets deployed into the US, consider something into the US. But India is something you can't go wrong with.
Yeah, that's encouraging to hear, given the fast GDP growth that we have. We all need to essentially be part of that growth story. So Carl, you did mention about the US markets and some of the technology innovation that's happening there. In that market, the amount of startups, the new innovative platforms, um, from Silicon Valley and investments thereof. So how could one get an exposure to that? So what's for somebody who's based in India, or for someone who's like us who's based in Singapore? So how do we go about taking an exposure to these to this? Should we look at individual stocks? If so, how to go about it? Or should we look at mutual funds, or what we call here the ELPs? So how do we any advice?
True. I think technology has delivered some of the best returns in the last decade. In fact, I was just telling some of my colleagues and friends, instead of going to college, I think we should have been watching more television, right, and investing in probably some amount of Netflix. That would have made significant amount of more money than getting a college degree and going to work. But jokes aside, I think the opportunities, we're in the midst of this new industrial revolution that that we all need to participate in and partake in. And this involves identifying structural themes. Those structural themes are more prevalent and present in the US context, very true. For example, and participating in any one of those opportunities, be they in Facebook, Google, Alphabet, or even the small startups, we can approach them using both listed as well as unlisted markets. And it depends on your profile, how you would like to approach it. If you have a significant amount of risk appetite, you could look at certain VC, private equity, or hedge fund based investing. If you're looking at a more a less aggressive way, more into public markets, more listed markets, one could always consider using funds, a listed stock that's available for us. So just to give you some example, I think this entire paradigm of investing has to be viewed in the context of how do you actually build this long-term strategy of putting aside some amount of nuts for the rainy day. Yeah. So I think this is a great picture you have here of this little squirrel was looking at picking on this nut and probably saving it or eating it. And in many ways, we are like these little animals that need to identify which is that nut tree. And the likes of, even if you see in the Indian context, right, the likes of Infosys have been that nut tree. From its listing in 1993 at roughly around 30 crores of market capitalization, today, if we had invested in companies like that, we would be participating in an increase in that market capitalization from 30 crores of market cap. Today, it's 5 lakh crores. So I think it's a great opportunity to participate in technology for people who have the wherewithal. Look at opportunities that come, structural themes that seem to change the narrative, disruptive ideas. Today we're living in a world wherein that linear growth path is no longer there. We're seeing an exponential rise in creation of wealth, exponential rise in creation of value, and that's happened only in technology. Right? If you see
Okay.
today, more than 50% of the S&P 500 is just 6 technology companies. There's not a single bank. There's not a single oil and gas company. It's Apple, Amazon, Facebook, Google, and Netflix. And yeah, possibly Tesla is close by.
Right. So when you're referring to structural themes, would one say that it would make sense for us to have at least part of our portfolio exposed to big tech and growth tech firms. So Arun, what are your views on this?
So, sorry. So how we view this overall the allocation piece. So let me talk only. This will primarily be from Indian perspective because we don't deal with the global. But whatever we deal with global is through whatever is available via India. So the way we approach for our clients is very simple. So we look at something called the five finger strategy for building our equity portfolio. So what we do is that we've studied almost close to around 100 years of data, not just in India. I mean, India obviously you don't have 100 years, you have close to 40 years. But we've seen data from US, we've seen data from Europe, and we've tried to see what are the stock picking elements that give you long-term outperformance. So this is not just us, but a lot of academic research has gone on this. And it, like, if you guys can Google saying that factor investing, you will find out what are the special characteristics that lead to long-term outperformance. So what we found out was there were close to three or four major ingredients which was working across the world. So it was working in US, it was working in Europe, it was working in Singapore. So any country you name it, any good decent stock market, like, these factors work. Now what are these factors? One is something called as a value investing. So something like what Warren Buffett earlier used to follow. So value investing is probably the most popular form of investing, where the concept is pretty simple, that these fund managers, or if you're picking stocks on your own, you will pick stocks which are reasonably pretty cheap in terms of what they're originally you think the price to be. So mostly this will be good companies which are going through temporary problems, because of which the price is reasonably very low, and they buy a bunch of these stocks and then they let it run, because the idea is that these are good companies, but at some point in time, when things rectify, there'll be a very strong price up. This is more like when there was tsunami, some people used to go and buy real estate near the shore, near the places which was getting affected, because their call was at some point in time the people will forget about this and real estate prices will start going up. So this is more like that. So that's the first bucket which we would say, which is value or contrarian. The second is something called quality investing, where they go for very high quality companies. So something like the tech names that you were talking about would fit into that bucket, where like they have very good profitability numbers. So any of these regular metrics that you follow will be like super abnormal for these companies. But again, the caveat is, the flip side is that these companies will be extremely high in price. But the argument is that it is super high quality, and hence we deserve to pay it a slightly higher price. So this is the next segment of thinking. So value quality guys are just opposite to value. Value is like anything high in price I won't pay. Quality is like anything low in quality I won't buy it, but I will rather pay for quality. So that's the second bucket. The third would be the mid and small cap. So be it any country, mid and small caps over a long run do much better than the large cap by maybe 1-2%. But obviously there'll be phases where they don't do well, but they do well. But when they do well, they compensate more than enough for not doing well at some point in time. So that's the third bucket. The fourth is what we call the global bucket, where we try to inculcate the global allocations for our Indian clients. And again, the fifth bucket is something which is unique to India, which is what we called as GARP, which is more of a Jugad version of all these investment philosophies for India, where these guys mix value. So they're like, I won't go really deep value, because sometimes it might be crappy companies and it might take a long time for the theme to play out. My clients won't be patient enough, and I won't go super high quality because they're very, very expensive. So it's like a jugaad. It's a pure Indian version of fund management. So what we do for us is we call it the five finger strategy. Very simple to remember. You take your five fingers. The smallest one stands for small and mid caps. This is the ring finger, so it stands for the quality. Middle finger is like contrarian, like I don't care what you guys think, but I will buy things which are beaten down. And the index is for pointing towards global, so that's where we buy the Nasdaqs, and there's also a tech index available. I mean, tech fund available from JP Morgan for Indian clients. So we are getting several options in terms of getting exposure to global. So I think the MF industry has taken it big time. So even for like $1,000, you can get exposure to any country that you want. So that's how India is also getting on the stage. And the last one is like more or less you get a lot of fund management companies like Mire, Cortex of the world, which will follow the GARP. So what we've realized is that when we put together this combination at 20%, 20%, 20% each, we've found that over a long period, we've tested it out of 15 years, 10 years, and different time frames. We've seen that what happens is this is more like a cricket team. It's not like all will perform well, but at every point in time, at every 2 years, 3 years buckets, you will find that two or three will hit the ball out of the park, and the other two will not do well. So right now, mid and small caps value is not doing well. So usually people don't buy it. Now the way in which we have structured it, we force people to buy it because they don't have a choice, but they build 40%. Maybe in the next 3 years, this will do well. The quality won't do well, and maybe tech might not do well because tech has already had 10 years of outperformance, right? If you really look at the period before that, nobody was buying tech because for 10 years it didn't do well between 2000 and 2000. So all these are cycles. So the whole idea is that we don't want people to get impacted because they take a call, and let's say you bulk it up to 50% of your portfolio, and unfortunately tech doesn't do well for some reason that we do not know at this time. So the whole idea is just to balance it out like a cricket team and then build it out. And obviously on top of it, the layer is you can build far more complexity. You can buy hedge funds, you can buy PE funds and all that. But this remains the simple core thinking process in a way in which we don't go overboard. At the same time, we don't ignore things which are not doing well. So this mentally helps us to communicate to clients, and also we've seen that the experience has been extremely smooth because the volatility is much lower than the large cap index, and at the same time the returns is almost like we get 3 to 5% outperformance on a 3 to 5 year basis over the Nifty index. So it doesn't mean that it'll always
Right.
be positive. Nifty is down,
Right.
it will still be down, but it'll be reasonably positive. So that's how we look
Right.
at it.
So would you advise someone like us to kind of invest on these different you spoke about 5 different categories: value, quality, mid, and small. So should we do this on a monthly basis, or should we do this? So is there any kind of a time interval that you would suggest? So that's one question. The other question is, could we make this a bit more dynamic? You mentioned that something like having an equated allocation of 20% across these different categories. So if some of these themes are not doing well, should we take a larger exposure on these themes at that juncture? Because intuitively, where some of the retail investors tend to do is to kind of enter the market. They try to time the market, but enter ultimately at the wrong time, and then also get out, sell out at the wrong time. So any thoughts on that?
Yeah, so earlier we tried this out because so earlier I was a part of a very large wealth management setup. So mostly we were dealing with a very large ultra HNI clients. But what we've realized is that it is very difficult to be patient because one, it is derived with conviction, right? Because I'm the one who's getting conviction derived from the fund manager, and the client is in turn getting it derived from me. So what we've realized is that sometimes these themes do not turn around in the time that we want. So it might take 1 year, 2 year, 3 years. So for example, mid and small caps have not done well for the last 3 years. But the rally started on 2013 end. But from the period from 9, 10, 11, 12, 13, none of them made money in mid cap. So basically nobody was touching mid caps at that point in time. And then the rally started probably in 14, 15, 16, 17 was a bumper. And then 18, 19, 20 has been really bad. So the whole point is we do not know whether the next change comes in 11, I mean next year or the year after that. So what we've realized is that if you take a very large exposure, then each and every time you see the other portion doing well. So let's assume the Nasdaq keeps going up and up. And so there's a lot of people calling that it's too expensive. There might be a bubble and all that. Like our point is very simple. It's too difficult to take a call on this. But the point is we don't want to be out of it. So I want to play Nasdaq, but at the same time, I am also reminded of the fact that, hey, in 17, everybody was gung-ho on mid-caps, but then it crashed and the entire portfolio went for a toss. Same thing in 2000s, everybody was gung-ho on NASDAQ. They went overboard. So the whole idea is that we might want to add in some more valuation layer and then give small increments, maybe instead of 20, keep it to 25 or 30. But we've seen that from a behavioral perspective, it is very, very difficult, especially if it under, because value, a theme which has worked for 100 years has not worked for 12 years in the US. And for India, it's not worked for 5 years. So what if it not doesn't work for another 3 years and I am only exposed to value saying that, hey, this theme has not worked. So, but at some point in time, it will give a bumper return. But the point is, it will come in very, very small periods. So if you really look at last 10 years, all the mid-cap returns came in one single year, 2014, 100% return. So it just doubled in 6 months. That's it. If you miss the 6 months, you're gone. So the whole funny part about this is the returns come in very, very short periods that if you try to time it too precisely, or if you just get impatient at the final leg, you might miss out on the whole thing. So our sense is this works really well, but for clients who are a little bit who know the things and who are okay with this, we let them go a little overweight or underweight, but not to a large extent, because we know behaviorally it's too difficult. The way we do it is yearly once you can rebalance it if it crosses plus or minus 5% from there. So if you build it at 20% and Nasdaq does really well, maybe value will come to 15% and Nasdaq will go to 25% or more than that. Then we try to rebalance it back. So automatically you are putting more money into things which are not doing well at the juncture, and you are cutting a little bit from things which are doing well. So at the same time, you are keeping exposure to both these segments. So that's how we look at it, and this can be followed across these patterns which I told, the quality, value, and all that. It's a global theme. It's not specific to India. So you will also get, you'll need to figure out which is the product based on which countries you want to play around.
Right, right. Carl, thanks. Carl, any your views, please, on this?
I think this picture is a very apt picture, very nice one of tulips, which also reminds us of how old this investing bubble and the phenomenon of investing bubbles is. Tulips remind us of this famous tulip mania, which led to the famous collapse, financial collapse in Holland. Right? So everybody knows Holland for its tulips, but they actually got the tulips from Turkey, and they started selling tulip bulbs, right? And they started experimenting with getting better and better tulips, more and more prettier tulips. They tried to modify it way back then in the 1630s, right? And then you have the famous uh, uh, period in which they started selling tulips for in today's time and age, it could be about $750,000 per tulip bulb, right? So if that tulip bulb could promise you a tulip which was prettier, more unique, people would spend that much money simply because they realized tomorrow there was somebody else who was ready to buy it for more. So that's how ridiculous things got. But back then, in 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 1630, everybody thought that tulip bulbs was the in thing. So they sold their farm and bought tulip bulbs before somebody suddenly realized what exactly are we doing, and that entire thing came crashing down. So taking on from Arun, what we're saying is that be it tulip bulbs or tech companies, we have been through several cycles of boom to bust. 2001 is still fresh in everybody's mind, wherein we saw a dot-com burst. With 50% of market capitalization by 6 tech companies, will it be regulation which is going to undo them, or some amount of innovation from other spaces of the market. I don't know, but tread cautious. This is a 400-year-old lesson that we can all learn from.
That's very interesting, Carl. Absolutely. So, of late, trading has become quite popular. I've read many articles, about millions of retail investors. Most of them millennials have taken up to trading, during this period in the last couple of quarters. I believe even the online trading platform in India, Zerodha, in fact, handles more daily transactions compared with uh, Robinhood, which is the US's most popular trading platform. So I'm really not sure how much of these new traders are making profits, but the larger question is, can trading be one of the sources of income that can contribute to long-term wealth creation? So what are your views on trading compared with investments, Arun?
See, trading requires a completely different mindset because it's a everyday game. Because in investing, the time frames are maybe 10 years, 15 years, 20 years. It's more like how we see real estate. But in trading, it's more of minutes, days, and hours, right? So unless and until somebody has the time and effort, and it's a full time activity. It's not like you can do something else as your main job and then do it on the side. It's too difficult, and historically we've seen that majority of people end up losing trying to do trading. It's only a very few minority which finally makes it up, and those are the guys who have proper rules, and it's not like a random thing. So it's like the odds will be like, even if you get it at 55-60% calls right, then it means you are a great trader. But a lot of people don't get it. They want 100% hit rate. And see, I think what is happening right now is that most of the people were stuck at home, and markets were volatile. You were getting opportunities to make quick money. So all these are phases, but I think eventually on the longer run, this is the first phase where somebody, when even I started my career, I just did a lot of trading, and finally I ended up losing money in the longer run, and then eventually you move to saner, boring stuff. So I think this is just a phase. There will be very small proportionate of people who will make money, and that too if they are like full time dedicated into it, and stuff like that. So I wouldn't suggest this as a great way to build a long term wealth unless and until you really want to get into this full time. I would
Right,
advise your clients, I mean your
right.
alumni, to be a little more cautious and not get too carried away.
You made a very interesting point. You mentioned, yeah, trading is exciting. I think some of us, if not all, would have attempted trading at some point in time. I do that sometimes, even now. I'm trying to figure out how to, make profit out of that. So, but the point that you just made is very interesting. You said it's better to do boring stuff that makes money than do exciting stuff where you lose, where you lose your money, right? So, Carl, you've been a trader yourself. So, what has been your experience? What's your advice?
Right. So I think you're spot on, right? Is the objective setting is very important, and it's always important to never lose eye of the ball. Investing is what you is the paradigm in which you're operating, and trading is possibly a technique or a tool in that investing toolbox. So, for example, in your portfolio and as a P&L of an individual, you know, you have to identify, okay, how much of real estate do I have? All right. How much of it is core holdings? How much of insurance do I carry? How much of loans do I have? How much of other asset classes do I have? Have I invested in myself as an individual? Have I invested in my family? Have I invested in relationships? And once these are addressed, then we can move on to looking at trading as a strategy. Now, there are umpteen number of trading strategies that we can adopt and one can look at towards monetizing gains, right? So you have momentum-based trading strategies, you have volatility-based trading strategies, you have different types of trading strategies. In fact, for every trading strategy, you have bots and even smarter individuals who come with counter trading strategies. So one should be very careful in terms of what exactly are you doing. And as Arun rightly mentioned, trading can lead to certain missteps, right? What we need to recognize at every stage of time is we are in the business of investing, in creating value. And that is done by having a identified objective and meeting that objective. Markets can move up, markets can move down, markets can move nowhere. Have your objectives been met? That's simply the most important point that one needs to identify and address and recognize. Trading may not meet that your objective if the market moves against you. But yet, you need to have met your objective. If your objectives are to generate a certain amount of cash flow, a trading strategy possibly will not address that requirement. So having a set of assets which delivers you the objectives that you want is simply critical.
Mohan, I think you are in mute.
I'm sorry. So Carl, that makes sense. The key takeaway is very few, of the whole lot that does trading actually make profit, on a constant basis, and it does require, a good amount of time and effort. We can't be do this passively, with just part time, with little information. I think there's a lot more forces at play, and we are seeing a lot of bots, and that kind of makes the intraday trading a very volatile, kind of a scenario for us to get in and make money, especially for newcomers. So Arun, I read one of your blog posts on 80-20 investor and the bear market, where you have covered some of the common behavioral pitfalls related to stock market investing and why most of our plans fail. So could you please speak a bit about that and how to go about investing in this volatile market?
Yeah, okay. That's this is something which is very interesting, even from a personal side, because what I had realized was for a long period of time, while all of us make really good starting plans, whenever a bear market hits, right, then the whole plan goes for a toss. Now you might say, what is the big deal about bear market? Because right now, when both of us are talking about bear market, it looks easy, right? 10%, 20%, 30% fall. Then you're mentally like in March when it fell 30%. So what happens is after 5 years, when you're looking at March, right, people will say like, why didn't people buy at 30% fall, at 40% fall? It was so easy there. But for all of us who lived through that phase, we really know how difficult it is. So the whole point is to agree beforehand that it's going to be extremely difficult, because day in and day out there's going to be some expert on the news saying that this is something that we have never seen before. The countries are getting closed and all that. So what we had done is that we knew this will happen. Not that we knew that this event will happen in March, but we knew that at some point in time there will be a bear market because of some reason which we cannot predict. So what we thought is that first problem was that you will end up making too many decisions, because what will happen every day there is a news flow. So you don't know whether to. So let's say we are in the middle of, let's say, March. Every day there's a news flow. So I'm like, should I do something to my portfolio today? And afternoon there's one more news flow. Your friend will say, hey, I took all my money off. See, I saved so much. Then every day you get bombarded. So you're like, every minute seems to be a decision making. So what we said is, first let's decide when we make decisions, right? Let's not even talk about what decisions we make. So let not every minute, every day become a decision making point. So what we said was, we will make decisions only at 20% fall, 30% fall, and 40% fall. Simple. We put the levels there. So something like, let's say, 36,000 or 32,000 and 26,000, something like that, around those levels at Sensex. So that for everybody, it's a common number. So what happens, even if it's at 31,000, we don't make decisions, because unless and until it cuts 30,000, we don't make decisions. If it cuts, it's well and good. Then the second point is, for these levels which you decide, put the plan in place. Like, what we do is we demarcate some portion of the debt, and we talk during good times. Like, if there is a market correction, would you want to take advantage? Everybody says yes, and they're like, what is the amount that you want? Then you demarcate, so that there will be like, save maybe 20%, 20%, 30%. But the whole point is, this gives you something to look forward to. Otherwise, like, you're there, you're like Rocky Balboa, getting hit day after days. Now what happens, the whole time frame changes, and then people are excited. They're like, hey, it's coming down. While the news is scary, our job is to make sure that this is fine. This is how every time it becomes scary, but the idea is to simply execute it. So we'll say, at 20% fall, move 20% of your opportunity bucket. At 30% fall, move 30% of your opportunity. At 40%, move 40%. Why did we take it as 20 and not 10 and 10%? Because 10%, 15% fall is a given every year. So that's not even bear market. That's like normal. If that should be okay with anybody who wants to invest in Indian equity market. For US, it will be slightly lower. So based on country, you might need to tweak these numbers around, but the whole thought process was that. And the best part was, it worked phenomenally well for us in the March thing. We did not listen to anybody. We just went ahead. Not that we had any clue that the recovery would be this fast. Maybe it would be
Right.
another 2 years, 3 years. But the whole idea is very simple, that all of you must keep a small paper which says 20% fall, 30% fall, 40% fall. What will I exactly do? And only these 3 days. Even if you don't decide, it's still fine, because when you're re-looking at it now, you will at least understand the fact that, hey, it is very difficult. While I wrote the plan, I was not able to. I panicked, because so that at least the next bear market, you will be able to take advantage. As long as you don't sell it out, it's still great. If you put in more money, it's fantastic. But our whole intention is that, because a lot of people went into cash in March levels. So that's like a disaster, and they don't know when to come in. Like, if you ask me, if I had moved to cash, I would have no clue, because the rally is completely confusing, right? So that's the whole. But this is how it's always been. Even in 2008, in 3 months, it was a 90%, 80% rally. So 3 months, you're out of the game, just like what happened this time. So our
Right.
simple idea is that, keep a plan and make it very, very simple, so that, like, it won't take a lot of time for you to execute.
Right. From where we are right now, the global markets, be it Sensex, or Dow, or Nasdaq, so they all have run up quite a bit, and very fast, like you just mentioned. So at this stage, what would your advice be for somebody who wants to enter newly into the market? Would you advise them to start making those investments in a small way, or it's shore up capital and then wait for that 20%, 30%, 40% fall, like you just mentioned, to enter the market fresh,
Yeah.
or to kind of allocate more cash into that into equity markets?
Yeah. So for new capital, the rules have to be slightly different. This is more for existing portfolios. For new capital, we simply say that, based on valuations, if it's so what happens is, 90% of the times, things are more or less in a fair valued range, but 5% it becomes very excessive, and 5% it becomes very, very cheap. So when it is very cheap, you obviously want to be very aggressive. You can directly go put one time lump sum. I mean, you can put all one shot. And if it is very expensive, you can stay in cash and gradually invest it. But these are times where it's slightly, the valuations are very high, but from an Indian context, still the earnings growth has not come up, and there are pockets, like mid caps are cheap, value as a theme has not played. So we are playing through pockets. So the 5 finger strategy, which I told, ensures that at least 40-50% is still reasonably valued. So we would ideally want to spread it out over a 6 month period. Not that we know whether it will go up tomorrow, but just that it's a lot more behaviorally easier if you spread it out, because even if it falls, you know that I still have more money to come. Even if it goes
Right.
up, it's still fine. Like, you're still participating gradually. But on the global front, we would broadly say that don't go overboard. So if your overall allocation to US is at 20%, don't make it, let's say, 25 or 30, because the tech stocks have kind of rallied like really significantly. All said and done, they are very good and all that, but still
Yeah.
it is not time to go overboard. At least stick to whatever was your intended original allocation. If it's 20, just stick to 20.
Right. Thanks for that. There are a few questions that have come in that are relevant to this phase, and stock market investing. Let me see if I can take some of this now, and maybe if time permits, then we can take some more after we cover the next two phases. So one question is on ETFs. ETFs have been a great way of reducing costs and playing the index. The question is, isn't index investing a lot better option and a low risk option? Carl, your views.
No, I think spot on. I think I can't agree with this anymore. I think this is absolutely the least risky way of accessing equity markets by the index. Right? And why by the index? It's simply because, on account of its construct, the index rewards performance and penalizes underperformance. So there is this constant, way in which it only increases and has the best performing stocks as its constituents, and rejects the underperforming stocks. Of course, choice of the index is also important, but within that scheme of things, index investing, there happens to be very little reason to look outside the index, given the fact that most active managers have really not been able to outperform the index over a full cycle. It calls for very, very good stock picking. Certain stocks have, there's no doubt about it. So, I mean, maybe one question we can throw out at the public, and which is the one stock which has probably delivered the most returns over the last 90 years?
Right. What about PMS? Are they better, safer way of investing as well?
So I
Given
think
that most of us may not be traders
the
keeping a daily.
so I think that the two questions are probably linked to one another. And one is, can an active management outdo a passive form of management? They can. And for example, I was just saying, alluding to, which is the stock which has delivered the most returns, and that's been Philip Morris, right? It's a sin stock. It's the cigarette manufacturer. Today it's called Altria. Over the last 90 years, it's delivered returns in excess of 2 million times returns, and this is not including dividends, right? So this is the kind of phenomenal rally that you have seen if you are invested in Philip Morris and the likes. Can an active fund manager in a PMS actually deliver those returns? They can. They can pretty much do that. But uh, how can you do it for the entire part of your asset? Are you likely to put 100% of your assets into one stock? I think it would be a little foolhardy. We could be building fresh bubbles up there. So
Right.
I suspect what
Okay.
I suspect, excuse me. So what I suspect is uh, PMS can form a part of a portfolio, but the bigger part is definitely the index purchases.
Right. So we have limited time. So what we'll do is we'll quickly cover the two phases and see if we can take some more questions from the audience. Right. So moving to the next phase, which is a wealth preservation or the management phase. Most of us would be between mid to the later part of our professional career during this phase. And we would be aligning our decisions based on retirement goals, trying to reduce the amount of risk exposure in our investments. At the most basic level, I believe we are trying to basically preserve what we have earned through the years and protect our portfolio from loss, right? So in this context, could you speak a bit about retirement planning and what kind of asset classes that we can consider to preserve and grow the portfolio. Arun?
Yeah. So broadly, once you've built a reasonable corpus, then again, the key thing is to.
Could you go?
Sorry, is it fine? Hello.
Yes, Arun, we are able to hear you. No, we are able to hear you. Go ahead, Arun.
Okay, sorry. So what happens is that once you build a reasonable amount of corpus, then the key thing is not even about returns. It's just that you don't want to lose it because you've struggled so hard for so many years that, and just you're all that you're looking for is a peaceful retirement. So suddenly the mindset changes, and now whatever is the declines becomes a very very important part of how you look at your portfolio. Earlier it was fine because you were still earning a lot, and then the savings was more or less higher than what the portfolio used to earn. But this is a stage where more or less the portfolio is also contributing as much as you. So you are working 30 days a month, and your portfolio is just sleeping around and making the same money as you. So then I think there is an interesting category of products in the Indian space called, I think you would also have equivalents in US or the other countries. It's called the dynamic asset allocation category, where based on some valuation model which each and every fund house will use, they will use separate models. But broadly, the whole idea is that when markets become very expensive, they will automatically reduce it. So what will happen is, in let's say markets become very expensive, they'll bring it down to 30% equity. And let's say markets become very cheap, they'll automatically bring it up to 70%. So you don't need to do anything. You just put the in the fund and then you relax, and everything is taken care by the fund. So that's a very interesting category, which is like grown really big time in the last 5 to 6 years, especially in the Indian context, because India has a very unique a special advantage compared to other countries, because here these products are taxed like equity. So what happens is, an Indian mutual fund, if you churn within the portfolio, you buy and sell stocks as a customer, you don't need to pay tax on it. I think globally, like you will be taxed on that as well. So in that sense, you can move from 30 to 80 and from 80 to 30 in 2 days or 3 days, and you will have no tax implication at all. So this is a fantastic product which I think all of you can consider as a part of your portfolio, or else you can manually build it. So the first option would be to manually build it, which most of your asset allocators would try to do, or you can build it on your own. But if you say, hey, I don't have time for all this, I want to outsource this, but at a very very low cost, then you can put it into these category of funds, and that can work. So I think that can be a good addition to your overall portfolio. But broadly, the idea is that when markets become expensive, you need to slightly taper down your equity allocation, and when it becomes cheap, you need to have a bear market plan where you can slightly increase it. Or if you can't do anything, you just rebalance it back to your original allocation each and every year. That also will solve it to a large extent, but based on how much of a complexity you can handle, you can slightly up the game a little. So that's my thought.
Right. Thanks. So, Carl, your views on retirement planning and asset classes that one could consider when someone is in the preservation phase or the management phase.
Right. I think the wealth preservation, wealth, and the retirement phase are probably phases which need a lot more attention than in the early wealth creation phase. And the reason for that is, in this stage, the likelihood for missteps or the appetite for missteps are pretty much low. No, we are living in this world which is volatile. There's a lot of uncertainty. There's a lot of complexity and a lot of ambiguity. The VUCA world, what we call it. And in the midst of all of this, we have this spot of assets, this sum of money, this estate that we need to defend, protect, and meet various requirements, right? Requirements that can be, health requirements, or probably some education for a young one, or marriage for a child. All these are things that weigh in on one's person or on one's decision making, in terms of how to address them. And there are different products that we would suggest that one looks at and considers. Key one of them being recognizing that there are certain liabilities that we all have to address over this particular stage of life, managing liability management becomes key. Insurance can help tackle some of that liability, so and you can treat insurance as one of two parts, either as an asset creation tool, and there are several products out there which I would suggest that you look and explore them with your advisor separately, which actually create an estate far greater than the premium that you actually go in to invest. It's a well-developed product in the developed world. In India, it's also gaining more and more traction. We also could look at how do you manage loans, right? So when you take a loan, we have to recognize that there are certain efficiencies that you can bring into that. By either borrowing at very short-term tenors, rolling them over at short-term tenors when the interest rate environment is high and likely to go down, or lock in longer-term rates when you recognize that the interest rates are so low and potentially likely to go up. So wealth preservation calls for, and this is a dilemma which many wealthy people face, right? They say that, okay, I'm rich. How do I ensure that I remain rich? One of the big thieves of wealth is inflation. Tomorrow prices will always be higher than today. And consequently, ensuring that you are indexed for inflation and in growing at that same rate of your demands is key. So for example, what are the tools that one can use to index against inflation? Clearly, business. Business is potentially one of the few ways that one can use to pass on higher input costs onto their end customers and make a profit in between. And equities form that categorization of asset class, which need to be part of a person in that particular phase. It has its own volatility, but it is an inescapable part of investing, especially in this phase of the life cycle. We are living longer and longer lives, healthier and healthier lives. Medical science is improving. Our own understanding of ourselves is improving as humanity.
Right.
All of these is something which leads us to have greater emphasis on this part of the life cycle.
Interesting. So, when we move to when we talk about taxation, I mean, it's a big topic in itself. But what would you suggest in terms of tax planning for a global Indian, right? So, who's working abroad, residing, outside India? Could you give some broad strokes on that, please, Carl? You've been kind of across multiple. You worked across different continents and countries.
Sure.
So,
Sure.
what are your views on that?
Sure. No, thank you for that. And I think this taxation is a very difficult topic, and it's a very personal topic. Each one of us have got to address this with a fine-tooth comb and in consultation with our individual tax plans, right? For a global Indian or for a global a person of who is transitioning across different geographies, we suddenly recognize that asset creation is turning global and consequently create certain liabilities when we transition from one geography to another. That's something which we always have to keep in mind. The simplest example I can give is if somebody goes back into India, right? If you go back into India, you suddenly turn from being a non-resident or uh, not ordinary resident from a tax perspective to being resident but not ordinary resident. The categorization of your person when you move into another geography has implications on your global wealth and taxation there. If you move into the UK or if you move into the US, it's possible that your global assets that you have acquired outside these particular geographies also come under the tax ambit. These are very critical decisions that and one has to evaluate in terms of how assets are held, how assets are booked, and how assets will be treated in an era of greater and greater mobility. I wouldn't like to comment too much in terms of what one should do or what
Yeah.
one should not do. But there are efficiencies that we can all bring into this entire exercise. I would like to, in fact, encourage people to consider how they can bring in efficiencies. Whether it is housing assets under a different arrangement, be it under a company structure, ensuring that in India, for example, capital controls are key, right? You can't do several things which you can do in the developed world simply because the rupee is non-convertible. You cannot buy dollars beyond a particular amount. You can't invest in global markets beyond a particular amount. And these limitations are something which need to be factored into account when you're moving out of India or you're moving into the country. Each one of them has got regulatory limitations, legal limitations, and of course, societal implications. Right? How your immediate family and your engagement uh, 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 views this also changes. Outside that very personal arrangement, the taxman always has a claim, be it in one jurisdiction or another.
Well, thanks for that. I just realized actually it's as complex as it always is. Add to this that the double taxation treaties depends on which country you're working with and your nationality, and also the ever-changing tax regime in our own India with
Absolutely,
respect to
absolutely.
income
And
tax.
in fact, different countries recognize that they would like to avoid people from evading tax in their different jurisdictions. And they've all come across and signed international treaties to ensure that the state is not defrauded for what is due from them. Double taxation avoidance is always there, and that is the basic premise of taxation. But we also have this automatic exchange of information treaties, which now enables governments to request information from certain banks. You earlier had a lot of Swiss banks shrouded in this aura of secrecy, in which they would not disclose information even if a state asked that information. Today, any government across the world can ask for information from an identified bank or banking system on the tax status of an individual and in terms of what have been the assets held by that particular institution. This has increased transparency globally. Not
Right.
only financial institutions, we're also talking about real estate. Today, you're in Singapore and in the developed world, the property registry documents are public documents. Anyone can go and view them, who is the owner of this particular apartment or this particular house or this particular land record, right? All these things are important in terms of increasing disclosures, transparencies, and efficiencies. I anticipate this only to become more and more transparent over the next couple of years.
Thanks for that. We are over the hour right now, so I'm just wondering if we can extend the discussion for another 15 minutes. I hope then it'll allow us to kind of take up some questions from the audience as well. So the last phase, which is the wealth distribution phase. This is a phase where most of us would likely not be working in a regular job and usually are in the retirement phase. Our assets are expected to generate the income for us to kind of live on and fund for us. But also one of the major concerns for individuals in this phase is how to efficiently and effectively pass on the wealth that we have built to the future generations and charities. Any approach and steps that one would have to kind of take in terms of transgenerational transfer of wealth, what are the implications on maybe tax or so Carl, could you speak a bit about that?
No, absolutely. I think this is a very good question, and I think it ties into one core principle, right? Especially for in the context of a global Indian or global person of Indian origin. And that relates to how asset gathering has been made. Right? It is important to recognize that this phase of asset transfer is an integral part of the asset creation phase. And it always weighs in on all of us. We're in the midst of a pandemic. There are a lot of worries in terms of how am I going to how am I going to be looked after? How am I going to transition wealth into the next generation? All these weigh very heavily on all of us. Your personal law plays a very important part in the global context, meaning whenever you move out of the country, you also carry your personal law with you. And the distribution of assets happens based on that personal law. It doesn't matter whether you're living in Singapore or you're living in Malaysia or you're living in the US. The legal system recognizes that the distribution of assets is a very cultural and culture sensitive basis of distribution. And consequently, you will probably need to understand where your assets are. What is your personal legal situation? Are you part of an HUF? Are you possibly born in a civil law society versus a common law society? Are you a Muslim? Will distribution of assets be guided by that particular law? All these elements are relevant before one decides in terms of this particular distribution phase of discussion. I would think that the simplest way probably for one to approach this is to consider, talking to your spouse, talking to your family member, setting up accounts jointly in terms of anyone a survivor. That ensures that almost immediately that asset, God forbid, something happens to one of you, the other one can take control of it. The other one is not left in the lurch. Even more important than that is, setting up basic hygiene elements related to this. Setting up a will, right? Avoiding the process of probate, right? The probate process is not an ugly process. It's a simple process. It is a very friendly process, and the judges who work through the administration of the probate also recognize the sensitive nature of that, and they are quite open. At least in India and in Singapore, it's very efficient. We also have abilities in which one can consider whether even before this will is set up or assets are held, do you want to transfer assets into an arrangement which can help you rule possibly from the grave? All right. So, for example, if somebody wants to ensure that you say probably my son is not so clever, he likes to spend a lot of money. How do we ensure I could possibly pass that asset to his son or his daughter down the line? And that can be done in terms of a trust format, in which you skip a generation, probably recognize, or you can look after. You can, or possibly you can have a situation in which there is one child who is not mentally capable of looking after a particular asset. Probably there is some congenital disease or some problem that the child needs to be looked after, and you realize that your lifetime is only so finite, and you can ensure that there is some form of a family charter in the most simplest fashion, in which you have some immediate near-term family members who look after it, or set up assets in a trust. And that trust actually administers the estate in such a way to look after the next generation or the generation thereafter. So, of course, choices of company structures are possible, trust structures are possible, but in the simplest format, getting family members together and identifying and helping them set up some form of a family charter could be key. So just to give you some example, in the Indian context, it's a very new style, a new way of doing it. Culturally, it's not something we do, but in societies which have held wealth for hundreds of years and possibly thousands of years, the Italian society, the Japanese society, these are very fundamental uh, parts of their decision making. You know, how do you transition wealth? How do you look after people who are incapable of? In the Indian society, we also had such a kind of a community-based setup in which you had a village panchayat or a set of village elders who would look after people who were not who were infirm and not capable of looking after themselves. But with the kind of urbanization that we are, and probably the breaking down of that social network, we have to identify possibly what are the other ways we can look to address it. I don't know how long the possibly the HUF will continue in its present fashion and form, but if it is undone, it could probably be another bottleneck for a lot of people. It'll be a lot of concern for a lot of people in terms of how else can they look after people who are some of their loved ones who are not capable of taking financial decisions. So just going back into what we're saying is the entire process of transitioning assets from one generation to another is something which depends on your personal law. It depends on the type of assets that you have. You know, you don't want to have an indivisible asset being divided. Also, when you transition asset from one generation to another, let's say, for example, you are living in the UK, you have a huge tax liability, right? Today, we don't have very active inheritance tax laws in India. What happens when that becomes relevant? Or if that becomes relevant? In the developed world, in the likes of the US and the UK, you have very heavy inheritance tax laws in which the person who inherits the asset often has to sell the asset simply to make good Her Majesty's treasury because of the tax liability created therein. So ensuring that the asset itself is not destroyed and dismantled when you transition the asset to the next generation is also very, very important. Uh, we also, when you make such kind of decisions, liquidity of the asset is also key.
Right.
Yeah, subtle differences in terms of, you know, when you, God forbid something happens to me, and I am the key decision maker. Is it possible that the family will take some time? They will struggle in terms of getting on top of the ball in terms of what exactly has this gentleman done or what exactly have these people done? So offering transparency is often important, ensuring that there is liquidity in the event of this entire of this will needing to be executed. All these things are important.
Thanks for that, Carl. So that brings us, I think we have kind of largely covered, the three phases that one would go through in building the, personal wealth. So we have, we have another maybe 5 to 10 minutes. We can just take some questions if that's okay. So I will request the audience to post their questions. Meanwhile, I'll take up some questions that were posted earlier. So I can see some questions related to US election and its impact on the markets, maybe US markets or maybe any implications to the markets in India. Anything that you have to say here, Arun?
So yeah, our sense is that there's only one person who really matters, which is the US Fed, which is the central bank. As long as they are pumping money or printing money, we are all fine. So all the elections and all is like very, very secondary, because the entire market rally is simply because they raised their balance sheet from 4 trillion to 7 trillion. Now 4 trillion to 7 trillion doesn't ring a bell, right? But just to put the context, that $3 trillion from 1 trillion to 4 trillion, it took them almost 6 years. Okay, in a normal thing, that entire 6 years of
Right.
money, they pumped it in 1 to 2 months. So just think about it. 6 years of your salary, if you got it in 1 to 2 months, that's like going berserk, right? So that's exactly what central bank has done. And the best part is they've also come out clearly and then told that whatever happens, we will keep this thing running till things normalize. So at least that is so. So the only thing we all have to be worried about is what are they changing their stance at any point in time. So all that we do is every week we see what are they saying. As long as they are continuing with this money inflow or money printing. Uh, we think from a market perspective, we think it'll be okay. The idea is that they will pump it up for some point in time. By then, the economy will recover, and then things will become back to normal. Then, at some point in time, they will have to reduce all this. But that's a picture which nobody has ever seen in the history, and we are all waiting to see how that whole thing unfolds. But that's for another day.
Yeah, I mean, yeah, liquidity is one thing that's been driving the market big time. So thanks to Fed, I think the phrase that I often hear is "Don't fight the Fed," right? So just 2 days back, Powell again just spoke about kind of zero interest or low interest rate, and I think that's going to be there for a long time to come, maybe a few quarters or maybe even few years, based on how fast the economy recovers. And I guess US enjoys that the privilege of having the reserve currency status. So they can actually print money. And increase the book size. So thanks for that, Carl. Let me see. What are the best platforms for investing in overseas stocks? So that's a question. So I'm assuming, yeah. So maybe I can ask this question. Maybe this is just about spelling out a specific. If you're comfortable to take this question, you can. For someone from Singapore, Arun, would you like to kind of to are you
Yeah,
in a
see,
position to kind of name any products?
yeah, see, when it comes to India, you can invest either directly into stocks. Now, almost all platforms are building the US part into their stock. So, any stockbroking platform that you take, the major ones, they are trying to inculcate US stocks also into it. So, maybe in another 6 months, you will almost see all the platforms uh, having allowing you to access US stocks directly. But if you can't pick stocks and you want to pick it through a fund manager, or let's say you want to buy an index fund, let's say you just want to buy Nasdaq index or something like that, you have several mutual funds. So I represent a platform called Funds India. So we also provide, and there are a lot of other platforms. There are
Okay.
Kuvera, there are Grow. So any you just Google any Indian
Yeah.
platform, you can get access to it. So that shouldn't be a problem. Whichever platform seems comfortable to you, you can go ahead with that.
Right. I would assume that's the same for Singapore as well. So the other question is, what are the rules any new investor needs to follow to do value investing? So what parameters tells us a stock is undervalued? Arun,
So this is like a
this is
this
a
is
big
like a
question, but yeah.
yeah, it's a very big question. So just broadly, earlier what used to happen was value investors, because this whole philosophy started around the 1930s during the depression. So it was pure quantitative kind of a thing where they look at numbers called as price to earnings, price to book. So for each and every stock there are some valuation parameters. So earlier it was very simple that they would say, hey, price to equity less than 10, price to book less than 2. So something like that, you would do some filters, you would pick the top 30, 40, 50 stocks, you let it run. Next year again you run the film. That's how value investing evolved. But now it's become a little complex because the numbers are not able to capture the complexities of companies like, let's say, an Amazon, which is running a completely different business model. So and Facebook's, where like WhatsApp is a model where like he's built distribution. Now a new app can basically become a feature. So the day he launches UPI or the WhatsApp payments, I'm sure a lot of us will stop using the other apps, because net what happens? You pay through Google Pay and then you come back to WhatsApp and you send the receipt to your friend saying, hey, I've paid you. Now, so I'm just saying, so, but this doesn't get captured, right? So these guys are killing. TikTok was a big thing. One fine day it went off, and now Instagram has almost taken it within a span of 1-2 months. So this is not getting captured in value investing. But so I would say that now it become a little more complicated. So, but the broad thesis is that to understand what can be the possible future cash flows from a company, bring it back and see if there is a large enough safety of margin. So let's assume you decide it's worth 100. Are you getting at 70, 80? That's the concept of value investing. But I think it will become a little too extended if I try to explain the nuances.
Yeah.
But I think maybe
Okay.
you should get through some blogs or something like that
Sure.
on that. So Safal Niveshak is probably something which can help you give a good sense of that.
Sure.
It's an Indian blog, but you'll get a global perspective.
Okay. Thanks for that. Maybe we just have enough time to take one final question. Any questions from the audience? We'll just give it a few seconds. Okay, so fine. So no further questions so far. So I think that so that brings us to the end of the session. It's been wonderful, great, insightful. We covered a very wide range of topics today, right from creating wealth and how do we manage, preserve it, and also transfer wealth. Obviously, the idea is to kind of um, get a high level understanding of how one should approach this. And obviously, each one of us have to kind of consider the different factors that Carl and Arun you mentioned. We have to kind of assess the risk appetite that we have, the amount of, and also it should be aligned to our financial goals that we have, what kind of at what stage of life that we need how much of how much of cash, and then kind of work backwards from that. Arun, you spoke about the different the five pronged approach in terms of value investing, quality investing, mid and small caps, the global bucket, and the mixed value. You spoke about a bit about the behavioral aspects that govern, how we should not try and time the market. We covered about trading and the time it takes, and the and a factor of a few people making money out of that. Quite a lot of topics there. So thanks, Arun, and Carl. Um, Again, very insightful from your experience from your own personal experience around taxation, wealth transfer, and preservation. Thanks so much for your time. We really appreciate this, and I hope the audience could gain from this session. Um,
Thank you for having us.
yeah, so thanks for that. Any closing comments from you who would be welcome?
Sure.
Carl?
I mean, so this is something of a bit of hygiene element. All of us have to go through this entire 3 phases of life. It's key that we all keep our chin up, keep smiling, and go happy investing. Yeah.
Thank you. Arun?
Thanks a lot for the entire session. Like, I really enjoyed it. And the basic idea is very simple, that investing is also simple, that and unfortunately people from my industry, including us, including me, we've made it a little more complicated for you. But the whole idea is that the basics are very simple. So don't get too enamored by complexity. Things can still be kept simple, and people do really make a very good experience via keeping things simple. So yeah, keep things simple. That's my final point.
Fantastic. Thank you. Thanks, everyone. Then we are concluding the session. Thanks again to the audience. Great questions. See you in the next chat session. Thank you, and have a great weekend.
Thanks.